What's up, guys? Welcome back to the Lending Bros Podcast. I am CJ. I am with Shane, and we are here to bro out.
Maybe I wanted to introduce myself, man. Why are you introducing me?
I'm sorry. Go ahead, Shane.
I'm Shane.
Shane.
Thank
So
you
good.
for
So
having
good to
me
have
on
you.
the podcast for us.
It's your podcast, too.
It's our podcast. Let's start with the state of the housing market in 2024.
Okay.
Let's start there.
All right. What have you been seeing in the housing market, Shane, so far this year?
Houses being sold. Yeah. No, we're starting to see houses start to sit on the market for a little bit,
Yeah, I've noticed that.
and less multiple offers.
Mm-hmm.
So that's cool for buyers.
That is good. No,
Not super cool for sellers.
also true.
Yep.
Yeah, I think I don't know if you've noticed this, and I'm talking to agents we work with, things like that. I think showings are down a little bit. But it's if you're a seller, right, it's a little hard to pinpoint. It's not, the market isn't making a ton of sense at the moment, right? So you have homes that will still garner multiple offers. I know we had one a couple weeks ago that I think had like 30 offers on it. But there are similarly priced and similar condition homes that are sitting. So it's kind of a little bit of the Wild Wild West. So I think, if you're a buyer, right, that obviously opens up a lot of opportunity for you. We have a lot of, probably most, I would say, of our contracts that we're getting have some sort of seller credit, right, or are under list price at this point. And, I'm sure we'll talk about this moving on, but there's a limited time where I think that's going to happen, right? I think we are, stop me if you've heard this before, we are very close to interest rates dropping.
We've never said
Actually, this time.
But for real, this time we mean it.
I actually mean this time.
Yeah.
Yes.
I think it's the feds. I think it's FBI's fault is why sometimes the showings are inconsistent.
Or the Secret Service.
Or the Secret. Yes. It's a hot take, man. Yeah. No, actually, the flyer that you sent out for showing all of the different statistics for closings in a month for the branch.
Yeah.
Thank you for doing that.
welcome.
Actually, I pulled it up really quick. I had an in-person buyer consultation in the office.
Nice.
Pulled it up and showed them because they're asking how. Like, we need $10,000 to do this rate buy down, this temporary rate buy down.
Yeah.
Like, how likely is it that we get this? And I said, well, based on actual data, and it made me look really smart.
I love that.
So the average, fun fact, was $7,200.
And seller credit.
Yeah. So in the month of May, just our branch that did loans in primarily DFW area, but all of Texas, had $7,200 of average seller credits going to the buyer, which is pretty cool.
That's awesome.
Yeah.
I mean, that's significant money for sure.
Yeah.
And I know, this kind of goes without saying, right? But I think for when rates had dropped, what was that? Probably middle of 2020 to end of 2022, right? I mean, this may not be the case. I don't know if I remember a seller credit in a contract for almost 2 years.
No.
So like that kind of shows you the difference, right, of the market. So we're really not seeing prices drop, right? We're seeing prices still kind of, steadily increase along historical averages in that like 3 to 6% range.
Yeah.
But what we are seeing, right, is more programs and the seller being more willing to work with buyers whenever they do go under contract and to get them under contract, right?
For sure.
So I think that's important to know, right, is at least yet, right, and I don't expect to, this isn't homes are sitting on the market, so they're depreciating. It's just the seller is having to get a little more creative when it comes to, helping out the buyer or, making their home more affordable.
For sure. 100%.
Yeah.
Some of the things that we're kind of seeing too is like mortgage lending is, even though the guidelines have been pretty consistent, pretty uneventful.
Yeah.
We're kind of seeing, I'm actually seeing a shift in some different kind of practices from people's priorities and kind of what they're looking for when they're applying for the loan. Are you seeing any changes or anything like that in your world on there?
Interesting. I haven't really thought about it. I do think one thing that has happened probably over the past quarter or two, right, is I think clients are starting to understand, one, that interest rates are a little high right now, but the conversation of, purchasing now when rates may be a touch higher and, locking in the price and then renegotiating your rate after the fact, right? That conversation, at least for me, has been a little easier, right? I feel like more people are starting to understand it.
Yeah.
Partly because I think there's a little more light at the end of the tunnel, right? They know it's going to be quicker.
Right.
but I do also think it takes a while for consumers to get used to what, the market is at, right? Especially with as aggressively as it moved up in 2023. I think there was just a lag of, just knowing where rates were, right? And that's fair. If you talk to a lender, beginning of 2023 to middle of 2023, I mean, your rate was legit probably a point higher, maybe 2.
Yeah. For sure.
So they've been a little more, I guess, understanding of the market and knowledgeable of the market. But what are you seeing?
Well, so I saw an article that said securing a mortgage seems tougher than ever today.
Love that.
Which is funny because the guidelines are actually exactly the same.
For sure.
Like, really, for a really long time. Like, nothing's changed, right?
Yeah.
So I think a lot of the issue is, as we're going into kind of the shift in the economy where I think, keeping up with the Joneses has kind of proved to be people are just going into a crap ton of debt.
Yep.
And the debt ceiling for the U.S. as a whole is at an all-time high, and also the consumer debt is insanely high. I don't have the actual numbers.
Highest it's ever been.
But credit card debt was just absolutely outrageous, right?
Yep.
So as a result of that, people's debt-to-income ratio, which is what we use to qualify people on, is high because they're now paying, instead of an average of $200 per month for monthly payments for credit cards, they're paying $1,300.
I saw a crazy stat, not to cut you off, but I think it was over half of I'm pretty sure this is, I don't know the exact stat, but I'm going to say it anyway.
Do it.
I'm pretty sure over half of the population is still paying off their vacation from 2023 on a credit card. Yeah.
So should I cancel my vacation next week?
If you're going to take a year to pay it off and pay interest on that, probably. Yeah.
It's already paid for. It's all good. Mexico. I know you like to give me crap for Mexico.
Oh, hey.
Huge Mexico fan.
You are a big Mexico fan.
Love it. Huge fan. So I think the biggest thing, focusing on, I think the solution for that is, we preach it all the time. I know you do. Focus on improving your credit score via lowering revolving credit cards, right?
Yep.
Lowering those debts. They have consolidation loans. You can do a home equity line of credit. There's a lot of different options and solutions to be able to help people out with that.
Yeah, I think that this is exactly what you're saying, right? But I think too many people look at just one specific thing when they're looking at purchasing a mortgage, right? And don't look at your overall household interest rate, right? Like if you're selling a house, right, and you want to put all of that into another home, right, which is a very common scenario we went into a lot. But you have a car loan with a 15% interest rate. You've got credit cards that are, there's some credit cards right now that in the 30% of interest. If you've got student loans, right, all of those are going to be higher interest than your mortgage, most likely.
Yeah.
And so you need to look at it from an overall household interest rate, right? If you can use some of your proceeds or some of your down payment, even if you're a first-time home buyer, to paying off high interest debt and rolling that into your mortgage. Yes, your mortgage may be more expensive, but if you're looking at it from an overall perspective, that's, you're writing your monthly checks every month for what you're paying, whether it's going to your mortgage or a credit card, doesn't really matter.
Yeah.
And I think, candidly, I don't think lenders do a very good job at that.
Yeah, for sure.
As far as looking at the entire picture, hey, they want to put 20% down, they qualify for 20%, approved.
Yep.
So I think it also matters who you're working with too.
Did you see the Barry B video that he did at a conference about
I did
blended interest rate?
Shout out Barry.
Dude, if you have because a lot of people they pump up their credit cards. They have average credit card interest rate is 27% today.
Average.
Average.
27. Yeah.
And it's like a third of the population have over $30,000 of credit card debt. It's something just absurd, right?
Yeah.
I think it's probably even higher than that. But so if you have a 3.25% interest rate on your house, $200,000 loan on a house, and you have $50,000 in credit card debt at 28%, your interest rate is not 3.25%.
Nope.
It's like 4.5%, 5%, right? So I think, like you said, right, working with someone that has access to those tools to be able to do that for you, it's not a daunting task. It's an easy conversation and looking at the overall debt cost.
Well, it's even less so access to the tools, right, and just more so like that's going to look at it like that.
Yeah.
Right? Like the tool isn't that hard. It's a pretty simple compound interest calculation, but you have to actually do the calculation and look at it from that. And not.
Wonder how many of our viewers would think a compound interest calculation would be pretty simple.
That's fair. You could Google it though.
Fill out this amortization calculator. Yeah.
Yeah, that'll go great. Yeah.
I think another thing as far as, talking about mortgage lending challenges right now is with higher debt to income ratios, something I've been seeing popping up a lot more is as a result of that, credit scores go lower.
Yep.
And we're also seeing that a lot of Fannie Mae and Freddie Mac products are requiring reserves for loans as well. And that's something that I haven't had to deal with really in 11 years I've been doing this,
For sure.
A lot of loans now. So now we're actually having to document more stuff to show people have extra cash in case. And it's not us that's requiring it. It's Fannie Mae, Freddie Mac. The government is the bad guy.
Yeah.
FBI, Secret Service. They're the bad guy. Jay's telling us to stop. Yeah.
I'm not saying to keep diving into that topic. It's funny.
Okay.
I think we have really good clips.
I thought we were getting this. I thought we were getting this from.
No, I'm telling you to stop. No, I think it's
Let's talk about conspiracy theories.
No, we're not. Stevie Wonder isn't blind.
Elvis is still alive.
Yeah, but no, I think to your point, I just got totally sidetracked. What were we talking about?
I don't know. Who cares? Let's go to the next thing. So predatory lending. So
Oh boy,
predatory lending isn't a thing anymore, right?
probably not true.
Yeah, let's talk about that.
Okay, let's talk about it.
Yeah.
Have you run into anything lately that has surprised you, or that a client has brought to you that would be borderline predatory or predatory?
So I think predatory lending can come in different shapes and sizes. I think the biggest opportunity right now is people are at all-time debt. They need cash, and they have pretty high-ish interest rates, right? From if they close the loan in the last 18 months. I think the biggest area for predatory lending right now is to have people refinancing for the wrong products at the wrong time. And this is something that we're trying to educate people on with our close clients, right? And our database is like, look, our goal is not just to save you money. Our goal is to have the lowest interest rate at the best possible time to save you the most money.
Yep.
So if you're at a 7.5% interest rate, doesn't that sound great to get 6.9? No, because
that's lower, Shane.
It's lower, and you could save $50 a month. But also, by the way, there's $10,000 in fees that are associated with that at this given time.
Yep.
And interest rates are projected to get into the 5s over the next 12 months, right?
Yep.
And we saw somebody. It was was it your client that got the refinance for 6.1%?
Yes. Yeah.
Let's talk about that.
Was not my client.
Okay, not your client.
I was just telling you yes, and I thought you were going to expand on it.
So it was a gentleman in our office. I think it was Stevens. So a gentleman in our office, one of his clients reached out to him and said, "Hey, can you get me a 6.1% interest rate? I got a 6.1 rate, and I want going to refinance with the other lender unless you can match it." And his interest rate was at the time was like 7.25, 7.25. So 1% savings in the interest rate. That sounds like a pretty good deal. Okay,
Yeah.
well, when he got the loan estimate, which is a government document that states how much the actual fees and everything are for it, they saw that there were 3% in buy down. So for this specific loan, it was like $11,000 to buy down to 6.1%. Well, the actual loan amount was only $300-something thousand. So really their break-even point would have been like 36, 37 months. And given that there's almost 100% chance right now that the feds will decrease the federal funds rate before the end of this year, it's probably not a good idea. That person may be acting in their legal right to refinance, to tell someone to refinance, but they're not acting as a fiduciary, in their they're not being a financial advisor to help them through that, for sure.
Yeah, and I think it's important to note, right? I mean, I'm sure there is a situation, right, where a client comes and like can't wait, to your point, right? Credit card's super high. Maybe they want to do a cash out and include debt, things like that. We're not saying you can't refinance clients right now.
Yeah.
Right. But I do think if it's just a client looking to get a better interest rate, right? They just see rates are lower. Unless you're doing refinances with zero close, like when I say zero closing costs, I don't mean
That means you don't pay anything at closing, right?
Yeah.
Zero out of pocket?
Yeah, the lender speak of, hey, zero out of pocket. I mean, genuinely, you're not adding anything to the loan amount. Then it's a tough sell with what you're expecting for interest rates, right? And so that, to your point, right, Is that predatory? Probably not. But is it acting in the client's best interest to refinance them whenever we're not even close to the bottom?
Yeah.
It's also probably not, right?
Agreed. 100%.
Yeah. All right, Shane. So I know one of the big things coming up here in the next few months is the election. All right. What do you think, rates are going to do, home prices are going to do with that? Do you think it'll have an effect or not so much?
Man, short answer is yes. I definitely think it will.
Yeah.
I know historically, I think they showed that interest rates have dropped after almost every single election.
Yep.
Right.
Yep.
But I think it's such a minimal amount. I think it's like 0.1%, right? Change in rates. So I really don't think that's going to be the changing factor. I think the biggest thing here, not a political statement, but there needs to be something that changes in the economy,
Yeah.
And with, President Biden actually recently dropping out, either way, we're going to get a change.
Yeah.
For
sure.
So I think that's kind of come bring in a kind of a new fresh face and new policies and everything with that. The most recent thing too with the Feds, there's almost 100% certainty that there's going to be a Fed rate cut before the end of this year in 2024.
Yeah.
Which will definitely help.
So it's like 90-something% for September.
Yeah.
Which I think, the Fed is not a political organization, right? But I think that's one of the reasons that you see, 8 of the last 11 presidential elections rates have decreased.
Yeah.
Because most of the time there's some influence there, and it always helps if you're a president and you're dropping interest rates and you can run on that right before. So they have that September I think it's middle of September 18th or something meeting that I believe is the last one before the election. I think there's one in December. Don't quote me on that. But so I think that's kind of the one I'm looking at where I think the election could come into play with that, and we may see what I follow, which kind of is an investor sentiment on what it's going to do in the market and what the Fed's going to do. I think last I saw was like 96% that they cut 25 to 50 basis points.
Yeah.
Which I think, and you're probably going here, not going to have a huge effect on interest rate, but what it will have a huge effect on is sentiment, right?
Yeah.
Buyer sentiment, and them thinking, oh, finally rates have been cut. Let me enter the market, right?
Yep.
So if you're borderline, if you've been pre-approved or you're thinking about purchasing, that date that I would have in mind is, and it's probably not an exact date, right? But sometime in that middle of September, where if you haven't purchased by then or gone under contract by then, it's not the end of the world, but you're just probably going to have to deal with a little more competition.
Yep, for sure. And a lot of the times, whenever the Feds make a big hike or a big rate cut in this scenario, a lot of times interest rates start going down in anticipation of that too. So I think we're definitely going to see that as long as the dot plot, Fed chairman voting on there still is likely to reduce that. I think we'll start to see a drop maybe in early September, maybe a mid-sixes. That'd be cool.
Yeah, and better than anybody, right? I think because, the other stat that we've talked about, that you talked about, right, it's home prices have gone up 7 of the last 8 years in the presidential election. But that's connected, right? Like normally when interest rates drop, demand increases, so home prices are going to. So that's, those are probably all connected, right? But yeah, with this being an election year and with this being as much craziness that is out there, right? I do think there's a very real possibility that if you're purchasing a home today, you're going to pay less than if you're purchasing a home January 1st, right? With what we have coming up with, the election, home prices, and interest rates. I think all those are going to kind of, lead to a probably busier, or at least I hope, a busier than normal Q4 in the housing market for sure.
For sure. Absolutely, man. Who are you going to vote for? Everyone's wanting to know.
RFK. Thanks so much for joining us on this podcast. If you have any questions or any disagreements on what we said, if you could send those to Shane, and any questions, just go ahead and send them my way. Thanks.
Yeah, y'all stay informed, stay cautious, and protect your financial investment. Let us know whatever other concerns you have. We're here to help.
Was that just off the cuff, or did he put that in there?
Wrote that down.
I was going to say, that's pretty good.